Hi, everyone. I'm Serena. I'm very excited to be here, and as I just said to Nicole, I'm also quite nervous, so bear with me. This is my first time I've given a talk since pre-pandemic times, and I'm sure a lot of you can sort of empathize. The ability to speak in front of people sort of degrades the more time you spend at home, so let's see how I do. So I'm going to be talking to you today about using alternative data in investing. So a bit about me before we begin. So my emojis aren't showing up, but that's okay. I had some fun emojis, but sometimes things don't transfer between Linux and whatever system is being used here. That's okay. So I'm a lead data scientist and quant researcher at Delphia. So Delphia was founded on the premise that people should be able to capitalize on the value of their data by using it to gain access to top-tier investment opportunities. So Delphia runs a retail investment strategy that aims to enable its members to build wealth by investing their data. Delphia also runs a hedge fund for accredited investors, and this is the part of the company that I work for. So you can say crudely that I work at a hedge fund now. In its first year, the hedge fund was the 5th highest performing long-short equity fund as measured by single-year performance in all of hedge fund history, which is something that I'm very proud of being part of the founding team. So in terms of my work at Delphia, what do I actually do? Well, so I do machine learning to predict stock fundamentals. So this involves everything from data and feature engineering to feature selection and model development. And when I say I use machine learning to predict fundamentals, I mean I predict things like sales, EBIT, these sorts of measures that are considered to be fundamental to a company. I'm also a co-host of Deep Random Talks, which is a YouTube talk show and podcast focused on machine learning and product development. And you can check out Deep Random Talks on YouTube, or if you Google Deep Random Talks, it hopefully should come up. And for those of you who do have a finance background, Deep Random Talks, the name is a play on the random walk, so like the book A Random Walk Down Wall Street. So I do recommender systems and NLP research with a particular focus on session-based recommendation and cybersecurity applications. Recently, I've published several papers at IEEE conferences. So a bit more personal, I enjoy playing soccer and riding my bike, even in the winter here in Toronto, and I foster dogs, and I do see my emojis are coming back, so I take back what I said at the beginning. I foster dogs, and a fun fact, I was recently named one of the top 25 women in AI in Canada by Rework, so thank you so much for this honor. It's just absolutely incredible to get this sort of recognition. So now let's get into the talk. So in this talk, we are going to cover, first of all, case studies to highlight the advantages of alternative data in investing. We will also talk about the promise of alternative data in quantitative equity strategies. So we'll first be covering alternative data and its potential use cases in investing in general. Then we'll get a bit more specific and talk about equity strategies. And then we'll wrap up by touching on the challenges of working with alternative data using Delphia's equity strategy as context and as an example for this discussion. So this is a talk about alternative data, so it probably makes sense to define it before we really get into it. So when I speak about alternative data, I'm referring to what it is not. So alternative data is not traditional. So traditional data sources are things like analyst estimates, earnings reports, and market-based data. So this would be things like price and price-derived features like momentum, for example. Alternative data sources then include things like social media, surveys, earnings call transcripts, which could be considered a sort of derivation of earnings reports, but actually the process of applying natural language processing on top of earnings transcripts or earnings call transcripts, this is considered to be quite novel and currently is considered to be alternative data. And there are also things like geolocation data, tweets, etc. So again, when you think of alternative data, Think of it as data that is not traditional. Okay, so now that we know what alternative data is, we can get into some case studies. So each case study will follow the same format. We'll talk about what the data is and then why we would care about it in investing in general. So our first example is related to Tesla, and the Toronto folks in the room might have heard this before because this case study was made popular by a Toronto-based company. So McDonnell, a couple years ago, before it was acquired and became NASDAQ DataLink, they obtained a data set from insurance providers. So the data set included information on insurance registrations of Teslas. So crucially, this means that the data set referred to cars that were actually delivered. So for a company that operates with pre-orders, it's like Tesla, it's crucial to understand how many cars actually have gone through to that delivery stage. And if a car has been insured, it must have been delivered and it must have been sold. So therefore, that delivery would have been included in the company's sales numbers. So why is this useful? Well, first of all, this data set was a weekly data set which allowed weekly tracking of sales. Given that public companies like Tesla, they announce their sales every quarter, this weekly measure made for a very high frequency measure of a lower frequency target, and this would really help your prediction exercise. And this quote at the bottom of the slide is dated from when the dataset first became available, and this describes why the dataset was so useful. And keep in mind that this is from the past, so it's in past tense. It says, "Industry analysts are not convinced that Tesla will meet its target, but the degree by which they will miss is a subject of great debate. McDonnell's dataset can help investors determine Tesla's progress ahead of analysts' estimates and production reports." So analysts at the time, in effect, they were in consensus. Everyone agreed that Tesla wouldn't meet its target. So having this weekly measure of sales enabled investors to determine the degree by which Tesla might miss its sales targets. So this is the crucial piece to take away from this. The important information investors were seeking, it wasn't whether or not Tesla would meet its target. They all thought Tesla would miss its target. They were seeking the answer to, by how much will Tesla miss its target? So the McDonnell data set provided a strong hint at that answer. So our second case study is related to JetTrack, which provides flight information for 1,700 aircrafts across 25,000 airports. And notably, these planes are operated by public companies in the Russell 3000, hedge funds, and private equity firms. So think about it. Why would this be useful? Well, this data set lets you see where CEOs are traveling and who they're meeting with, which could be quite powerful. And this quote describes how useful the data was. So the quote says, "This data has been used in numerous cases to predict corporate events, like when Constellation Brands kept flying up to Ottawa at an increasing frequency before making a $3.8 billion investment in Canopy Growth Corp." So, as you can hopefully see, if your investment strategy relates to corporate events such as mergers and acquisitions, this sort of jet tracking data set would be very powerful to have a hold of. And our third and final case study relates to the Chinese economy. And this relates to a company called SpaceKnow. So SpaceKnow is a company that provides what they call ultra large scale planetary analysis through satellite images. So I take this to mean that they use computer vision to analyze satellite imagery, and through this they can identify cars, boats, trees, shipping containers, maybe even pollution, that sort of thing. So SpaceKnow created an index called the Satellite Manufacturing Index, the SMI, which was a play on China's Purchasing Managers Index, so the PMI. They did this by analyzing images that are indicative of manufacturing activity in China. So why would this be useful? Well, the PMI, and therefore the SMI, since the SMI tracks the PMI, can be used to predict major economic activity like GDP. And by the way, other companies have PMI, or sorry, other countries, not companies, have PMI as well. For example, the US has a PMI measure that is quite important in financial markets. And this quote describes it well. So this quote says that SMI, so this is the Space Node Manufacturing Index, or Space Node Satellite Manufacturing Index. It's an independent measure that's published more frequently than the PMI every Monday, Wednesday, and Friday, making it the fastest and most reliable gauge of Chinese industrial activity. And really, anytime you have a faster signal of something that is known to be economically meaningful, this is very powerful. So far, we've talked about the promise of alternative data in general. So let's switch gears a little bit, or at least get a bit more specific and talk about the promise of alternative data with regards to equity strategies in general. So that is, if we want to buy and sell stocks, how could we make use of alternative data? So first, let's talk about credit card transactions. And this is actually an example that we previously used at Delphia a few years ago as a piece of educational content for our users. So imagine I could see all of your credit card transactions. Imagine I knew when you visited Starbucks and that I could see how much you spent when you visited. A bit invasive, perhaps, but data vendors do in fact know this information about you, and hedge funds do purchase this data. And now, imagine that I could see this information, that is your credit card transactions, not just for you, but for all Starbucks customers. So why would this be useful? Well, many quant strategies focus on predicting fundamentals like sales. In fact, this type of strategy is often referred to as quantamental. So a quant strategy is one that systematically predicts some target over thousands of companies. A fundamental strategy relates to one that predicts fundamentals of companies, so the combination of the two is called quantamental. So in a quantamental context, you can see that credit card transactions can provide a powerful approximation of sales. So hopefully you can see how if I was building an ML model to predict sales, this model could become much more accurate if I included credit card data, as illustrated by this Starbucks example. And really imagine how powerful this could be if you could see this sort of information for all consumer companies. So another example of alternative data that could work in a quant equity strategy is the Consumer Confidence Index. So the Consumer Confidence Index, it's also referred to as the CCI for short, and it's an index that is published monthly by the University of Michigan and the Consumer Bureau, Business Bureau, I believe, and it's derived from survey data. So some do view it as a leading indicator of the overall health of the US economy. Some say that it's garbage. Essentially, it provides an indication of future developments of household consumption and savings. So a CCI value of over 100 signals a boost in consumer confidence towards the future economic situation of the US. And as a consequence, this would mean that consumers are less prone to save and more likely to spend on major purchases in the next 12 months. CCI values below 100 indicate a pessimistic attitude towards the future economy, which could result in a tendency of consumers to spend less and save more. So CCI, it can be used to predict customers' propensity to spend. So then you can draw a link between CCI and the sales of products made by publicly traded companies in the consumer sector. And it is actually possible to create a weekly measure of CCI using survey data. So again, CCI is published monthly, but you can replicate a weekly version of it. And this is something we did at Delphia before. And it's actually quite simple. It involves asking people questions like, compared to this time last year, how do you feel about your current economic situation? So maybe think of it, everyone in the audience. How do you feel about your current economic situation right now compared to last year? And I want to draw your attention to the figure on the right. So this demonstrates and shows interest rate expectations, which is a measure derived from CCI. And we can compare this to actual changes in interest rates. So you can see from the plot that CCI looks like a leading indicator of interest rates. So given all this and beyond this, how is CCI useful? So first of all, as I mentioned, if you can create your own survey to measure CCI, you can create a faster measure of a well-known economic signal, and this is very powerful. And in investing and quant strategies in particular, when it comes to information, you either want to know information that other people don't know, or you want to know that same information but faster. So if you know information earlier than other people will, this can put you at an advantage. And if you can encode this information, so take these survey results, take this time series of CCI, and feed this into your model, this can boost your predictions in a quant strategy as well. And this would allow you to take a position in a stock before the rest of the market does. And finally, take a look at this figure of the current CCI, so you can see things have sort of dropped off a cliff in 2022. So do you think we're heading into a recession? So at this point, we've discussed the promise of alternative data in investing in general and alternative data used in equity strategies in particular. But let's be a bit pragmatic and talk about the challenges of alternative data, because it's not always so rosy, and we'll use Delphia's strategy as an example and for context for part of this. So the first challenge is that humans are biased, so we care too much about what other people think, often to a fault. I know that I started this talk by saying I was nervous, and it's because despite my best efforts, I care what other people think, so I hope you're all enjoying the presentation. So let's say that you were creating a survey with the task of forecasting US midterm election results. So if you were to ask people, who are you going to vote for in this election, they will likely say what they think you want to hear. And this would result in a poor forecast. So if you were to feed this sort of data into your model, it wouldn't give you much of a lift, and it might actually be a detraction. So here's the mitigation, and it's actually quite simple and profound, in my opinion. So don't survey people and ask them who they plan to vote for. Ask them who their friends are going to vote for or who their neighbors are going to vote for. This has been demonstrated by researchers who forecasted election results using the wisdom of the crowd methodology. So really this means if you ask people who their friends are going to vote for, you can predict elections. And the wisdom of the crowd, by the way, this is a theory that the collective knowledge of a group is better for decision-making and problem-solving than the knowledge of one individual. And I like to think of it as we're better together than we are on our own, so why not collaborate? And to connect this to a quant equity strategy, this means that if you're attempting to survey consumers to determine their spending habits, it might be best to ask them about their friends' habits, not theirs. And by the way, the researchers that I mentioned who forecasted election results using the wisdom of the crowd are actually people I worked with at Delphia, and their work really spawned a lot of the work we do today at the company. So a second challenge in working with alternative data is that we need the data to be representative. It's not enough to obtain alternative data from any data set. You shouldn't really just go buy this data from any vendor. We really need to care about the data being representative of the overall population. So again, we need what's called a representative sample. So a representative sample is a subset of a population that seeks to accurately represent the characteristics of that larger population. So it often does yield the best results in prediction exercises, but it can be the most difficult to obtain. So let's just use the example of creating our own CCI, Consumer Confidence Index, using survey data. If our sample was everybody in this room, we would likely not get a representative sample because we are all interested in technology, Many of us likely live in Toronto or the Greater Toronto area. Some of us might have flown in. If we flew in, we likely are well off enough or work at companies that are able to pay for our flights. So the outlook of the group on the overall economy would not represent the overall population's outlook. So how do you mitigate this? For this, we can use a method called post-stratification. So this is where you adjust the weights of the undersampled and oversampled populations, and you do this so that you can obtain an overall sample that's representative of the true subpopulation distributions of the actual target population. That's a bit wordy. Really what this means is you can apply some sort of re-weighting algorithm to survey respondents' answers, conditioned on demographics, and then you can obtain a representative sample. A caveat, though, with post-stratification is you need to collect demographic data up front when collecting survey results. Therefore, you need consent from survey respondents. And you also need to know the overall target's population distribution, which can actually be done quite easily if you have access to census data. So having a representative sample, it is a concern, but there are certainly steps that can be taken to mitigate this. And now for our final challenge. This is the largest challenge, and this is where I'm really going to refer to Delphia's strategy, at least lightly. So in a quant strategy, you need what's called cross-sectional data. So quant strategies often trade thousands of stocks in a single portfolio. This high number of securities, according to some, is what defines a quant strategy. So this quality, that is having a strategy made up of thousands of stocks, is called high breadth. So let's say you have a signal defined for a single company, but it's null for every other company in your universe. That wouldn't really do much. I mean, how would knowing consumer sentiment towards Twitter help us if that's the only company for which our signal is defined in our feature set? Our machine learning models likely wouldn't pick up that single signal. Now, the mitigation here is to investigate low breadth or low signal strategies and models. And this is something we're currently interested in at Delphia, and we are actively working on it. So for example, we're currently doing studies to understand the sort of true breadth requirements of our strategy. That is, do our models require features to be defined for 10% of our companies? Or is it more like 50% of companies? Or do we really need full feature coverage over all of our companies in order to gain any or apply any lift to our forecasting? So if anybody has experience in working with high breadth strategies but low breadth signals, please do reach out to me and share your thoughts and experience. And finally, thank you. So thank you everyone for being here, and to Rework and Nicole for giving me this opportunity to speak. So you can email me at my personal email, so smmcdonald@gmail.com. My Delphia email is simple, just serena@delphia.com. We are hiring right now. Specifically, we're looking for an infrastructure engineer to work on the asset management side of the business, so you would get to work with me. So please do email me if you're interested in learning more, or if you know anybody who works in DevOps or MLOps, let me know. And as a final call to action, please do check out my podcast, Deep Random Talks. And again, you can find that on YouTube or eventually anywhere you find your podcasts. So yeah, thank you.